Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Chevron stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Chevron is engaged in every aspect of the oil and natural gas industries, including hydrocarbon exploration and production, refining, marketing and transport, chemicals manufacturing and sales, and power generation. The company is headquartered in San Ramon, California, and was founded in 1879. It went public in 1978 and trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, and many other stock exchanges. The company's most significant areas of operations are the West Coast of North America, the US Gulf Coast, Southeast Asia, South Korea, and Australia. It produces 800,000 barrels of net oil equivalent per day in the US. Let's get started with the model. This is a large cap company, 212 billion market cap. They're trading at $110 a share and they have 1.9 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see in 2018 they had $17 billion of free cash flow, but it's down to $2.6 billion in the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that was $15 billion in 2018, negative in the trailing 12 months. Revenue is the sales for the company, and that was $159 billion, decreasing to $95 billion. The reason their financials are so weak is because of the lower oil prices. Low commodity prices gives this company weak revenue and low net income and low free cash flow. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is the gross profit. They had their lowest gross profit in the trailing 12 months at $24 billion, down from $45 billion in 2018. Then below that is operating expenses. Then below that is operating income. And they had negative operating income in 2020 and the trailing 12 months. Then below that is the interest they pay in their debt, and that's about $700 million a year, peaking in 2019 at $800 million. Then below that is other income and expenses. Then the bottom line of the income statement is their net income, which was negative in 2020 and the trailing 12 months, but positive in 2018 and 19. Low net income due to lower oil prices. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. You can see they were generating over $30 billion of cash flow in 2018, and that's cut in 1/3 to $10 billion in the trailing 12 months. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they do have positive free cash flow every year, which is good. They do pay about $10 billion in dividend payments. So in 2020, they issued $23 billion of debt, paid down $16 billion. So they added a lot of debt so they could fund their dividend payments. In 2018 and 19, they paid down debt because they had enough free cash flow to cover their dividend payments. They're also repurchasing stock. They repurchased $600 million in 2018, $4 billion in 2019, then $1.5 billion. Every time a company purchases capital stock, it decreases the shares outstanding, making your shares more valuable. Let's look at the capital structure. $132 billion of equity, $44 billion of debt. They're 75% equity, 25% debt. Their net debt is $39 billion, and their WACC is 8.43%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $283 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $248 billion. We divide that by 1.9 billion shares. And we get a calculated stock price of 128. They're trading at 110, so they're trading at a 14% discount. It's a buy according to the model. Simply Wall Street's valuation is 144, so they're also saying the stock is undervalued, more so than me. 16 analysts priced this stock, and the average price target was 119, the low was 101, the high was 130. This is a stock price the last 5 years, so you can see it was pretty steady for about 4 years, then took a major dip last March when the market crashed. It has come up a bit since the bottom, but it's still trading at a discount relative to its all-time high. It looks like it peaked at about 130 a few years ago. They seem to raise their dividend each year. They were paying 107 in 2016. They're up to 129. They pay a nice dividend, a 4.69% dividend yield. And since they have negative net income, we can't look at that payout ratio. They pay out 388% of their free cash flow, so they need to take on a lot of debt to fund their dividend payment. Their industry pays a 4.7% dividend. They're at 4.9%. Analysts are forecasting their dividend to grow to 5.1% in the next 3 years. This company's revenue and profits are highly dependent on the price of oil. Oil is currently $65 a barrel, but when it was $80, $100, this company was making a ton of money. There was a point oil was negative. The price of oil wasn't negative, it was the future contracts. The reason it was negative is because there wasn't enough storage space to contain all the oil. So instead of companies receiving money for their oil, they actually had to pay someone to take their oil. Another factor to consider when investing in this company is the demand for oil. This chart shows the actual demand of oil, and if it's business as usual, it should hit 120 million barrels of oil per day. But if we become more efficient on the way we pull oil from the ground, that could drop to 110. But if EV car sales reach 78% by 2040, oil will drop to 100 million barrels per day. There was a recent problem with the Colonial Pipeline that's disrupting the oil market. In certain states, people are waiting a really long time to get gasoline for their car. In the short term, this could increase oil prices, which may benefit this company, but in the long term, I don't see this being much of an issue. They have a beta of 1.3, so the stock moves a little more than the market. The stock has gone up 18% in the past 52 weeks, while the S&P 500 went up 44%. The 52-week low was 65, the high was 113. And the stock is trading above its 50-day and 200-day moving average. About 10 to 11 million shares are traded each day on this stock. Of the 1.93 billion shares outstanding, 1.88 billion are on float, 68% are held by institutions, and less than 1% of the shares are shorted. In the past year, this stock has gone up 22%, while its industry went up 49% and the market went up 52%. In the past 3 years, this stock has decreased 3%, which is better than its industry of decreasing 14%, but the market went up 64%. In the past 5 years, this stock has done much better than its industry, but much worse than the market. Analysts are forecasting their earnings to grow 16%, its industry 20%, and the market 15%. Analysts are forecasting their revenue to grow 3.5%, its industry 4%, and the market 9%. In the past 5 years, their annual earnings decreased 15%, its industry increased 3%, and the market increased 12%. In the past year, their earnings decreased 300%, its industry decreased 40%, but the market increased 17%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $15,700 today. That's a 57% total return, a 4.6% annual return. The biggest shareholder is Vanguard at 8.2%, then State Street, BlackRock, Capital Research, and Berkshire Hathaway. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at a PE. Price to sales is stock price over sales per share. They're at 2.2. So that means investors are paying $2.20 for $1 revenue. That's better than the median and average. Price to book is stock price over book value per share. They're at 1.6. That's also better than the median and average. They have negative EBIT, so they have negative return on invested capital. negative interest coverage ratio, negative ROE, and their current ratio is 1.2, so they can cover their current liabilities with their current assets. And their current assets are $5.6 billion of cash, $11.5 billion of receivables, and $5.7 billion of inventory. So the company does seem to be undercapitalized. They had $2.6 billion of free cash flow, $3.9 billion of working capital, but they have a $10 billion dividend payment, so they're short $3.5 billion. So they're going to need more debt or equity to run their business over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 9 companies in the same industry as Chevron. And if Chevron has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in all the price multiples. Their current ratio is about average. Their ROE is negative, similar to most companies in this industry. They are lower in debt than average. And they're by far the biggest company of this group. And they pay a higher than average dividend. So to summarize, I have them trading at a 14% discount. This is a really big company that's been around a long time. So I think it's a great long-term play. Plus you get your nice dividend payment. The stock may move up or down in the short term, but in the long term, I think you should be just fine. I rank their free cash flows 4 out of 10, their revenue 5 out of 10, and their ratios 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.